Ratio analysis is a method of evaluating and interpreting financial statements to understand the financial performance and health of a business. It involves calculating various ratios that provide insights into different aspects of a company's operations, profitability, liquidity, solvency, and efficiency. These ratios are derived by dividing one financial metric by another, such as dividing net income by total revenue to calculate the profit margin ratio. Ratio analysis helps investors, creditors, and management make informed decisions by comparing the company's ratios with industry averages, historical data, or competitors' ratios. Ratio analysis has several applications across various areas of business and finance. Here are some key applications. Financial performance evaluation. Ratio analysis is widely used to assess a company's financial performance over time. It helps stakeholders like investors and creditors gauge the company's profitability, liquidity, efficiency, and solvency by comparing key ratios such as return on equity, ROE, current ratio, and debt-to-equity ratio. Comparative analysis. Ratios allow for easy comparison between companies operating in the same industry or sector. Investors and analysts use ratio analysis to compare a company's financial performance with its competitors or industry benchmarks. This comparison helps in identifying relative strengths and weaknesses. Trend analysis. By analyzing ratios over multiple periods, such as year-on-year or quarter-on-quarter, businesses can identify trends in their financial performance. This trend analysis helps management and investors understand whether the company's financial position is improving, deteriorating, or remaining stable. Forecasting and budgeting. Ratio analysis plays a crucial role in financial forecasting and budgeting processes. By analyzing historical ratios and trends, companies can make informed projections about future financial performance and set realistic financial goals. Risk assessment. Ratios also aid in assessing the financial risk associated with a company. For example, analyzing liquidity ratios helps in understanding a company's ability to meet short-term obligations, while solvency ratios indicate its long-term financial health and ability to repay long-term debt. Investment decisions. Investors use ratio analysis to make investment decisions. They assess a company's financial ratios to determine its attractiveness as an investment opportunity. Ratios such as price-to-earnings, PE, ratio, and dividend yield are commonly used by investors to evaluate stocks. Credit analysis. Creditors and lenders use ratio analysis to assess the creditworthiness of a company before extending credit or loans. They analyze ratios like debt-to-equity ratio and interest coverage ratio to evaluate the company's ability to repay its debts. Management performance evaluation. Ratio analysis helps in evaluating management's effectiveness in utilizing resources and generating returns for shareholders. It provides insights into operational efficiency, asset utilization, and profit generation. Overall, ratio analysis is a powerful tool that provides valuable insights into a company's financial health, aiding in decision-making processes across various functions within an organization and for external stakeholders. Here's a step-by-step guide on how to perform ratio analysis using Microsoft Excel. Gather financial data. Collect the financial statements of the company you want to analyze, including the balance sheet and income statement. Ensure you have data for multiple periods, example, quarterly or annually, for comparative analysis. Open Excel and organize data. Open a new Excel workbook. Enter the financial data into separate worksheets for the balance sheet and income statement. Label each worksheet accordingly. Calculate relevant ratios. On a new worksheet labeled Ratio Analysis, create a table or list to calculate the ratios. Label each ratio you plan to calculate, example, liquidity ratios, profitability ratios, solvency ratios. Start by calculating liquidity ratios such as the current ratio, current assets current liabilities, and quick ratio, quick assets current liabilities. Next, calculate profitability ratios like gross profit margin, gross profit total revenue, net profit margin, net income total revenue, and return on assets, net income total assets. Proceed to calculate solvency ratios such as debt-to-equity ratio, total debt total equity, and interest coverage ratio, EBIT interest expense. Use Excel formulas. In Excel, use appropriate formulas to calculate the ratios. For example, to calculate the current ratio, enter is equal to B to B3, where B2 represents total current assets and B3 represents total current liabilities. Use absolute cell references, example $B$2, when copying formulas across cells to ensure correct calculations. Format and interpret results. Format the ratio analysis table for better readability. Apply number formatting, borders, and colors as needed. Interpret the calculated ratios to gain insights into the company's financial performance. Compare the ratios across different periods or against industry benchmarks to assess trends and relative performance. Create charts, optional. To visualize the ratio analysis, create charts such as bar graphs or line graphs using Excel's charting tools. Select the relevant data range, go to the Insert tab, choose the desired chart type, and customize the chart elements, example, axis labels, titles, legends. Document findings. Finally, document your findings and analysis based on the calculated ratios. Summarize key insights, trends, strengths, and areas for improvement. By following these steps, you can effectively perform ratio analysis using Microsoft Excel, allowing you to analyze and interpret financial data to make informed decisions.